From the campus of the University of Pennsylvania Wharton School, this is Wharton Business Daily on Business Radio.
June the 14th. Great to have you with us. I'm Dan Loney, coming to you from Philadelphia. Hopefully you're enjoying your day wherever you are around the United States or up into Canada. Coming up on our show today, we will hear later today from Fed Chair Jay Powell about interest rates. Expectations are for a pause, especially after yesterday's CPI data and today's PPI report. But how close might we be towards the end of this rate increase cycle altogether? New Twitter CEO Linda Yaccarino digging into her job, but not everyone is happy with the path that she may be taking the social media platform. We're going to discuss the challenges that lie ahead for her. Energy prices have been much higher in recent months as inflation has really left its mark. We're going to discuss what lies ahead, especially for oil prices. And the last 3 years have seen tech giant Apple focus on an initiative around racial equality and justice. We're going to talk with Apple about what they have found out. All of that and much more over the next 2 hours. But first, let's start things off with a look at today's business headlines. And as we mentioned, we got that producer price index report earlier this morning. Producer prices for the month of May down 0.3%. When you strip out food and energy costs, they were actually up 0.2. The headline numbers showing prices up 1.1%, ex-food and energy up 2.8%, and that number was the lowest level since February of 2021. The European Union has charged Google with breaching antitrust rules in advertising technology, and this could lead to the bloc seeking to break up parts of Google's business. A slight decline in mortgage rates helped lead a surge in mortgage activity last week. The Mortgage Bankers Association saying the average 30-year fix fell from 6.81 to 6.77%, and that led to a jump in refinancing activity up 6% for the week, as well as an increase of applications to buy a home up 0.8% for the week. PGA Tour Commissioner Jay Monahan is taking a medical leave of absence from running the golf tour. The medical condition was not mentioned, but it comes just days after the controversial deal to now partner with Live Golf after a prolonged legal fight. AMD says that its most advanced GPU for artificial intelligence will start shipping to some customers later this year. It is known as the MI300X. It is seen as a direct challenger to NVIDIA, which leads the segment right now with an over 80% market share. And Nielsen data says that Bud Light is no longer the top-selling beer in the U.S., at least in the month of May. Modelo Especial took over the top spot during the month with 8.4% of retail store beer sales. Bud Light came in second at 7.3%. Some of this may very well be tied to the boycott put in place by some consumers over Bud Light having transgender influencer Dylan Mulvaney as a spokesperson. Take a look at Wall Street right now. Markets are mixed. Dow Jones Industrial averages down 93 points at 34,117. The NASDAQ on the plus side up 17 points. S&P 500 ahead by 8. Oil prices moving higher. West Texas crude up 1.25% at $70.31 a barrel. And as for cryptocurrency, Bitcoin prices moving higher, up almost 0.5%, 25,993. Ethereum prices up fractionally, about less than 0.1% at 1,740. Don't forget, you can follow us on social media every day. My Twitter account at Dan Loney, Loney 21. For the show at Wharton Biz, B-I-Z Daily, and for the channel at SXM Business. Well, it is Fed decision day on a next potential rate increase. We will hear from Fed Chair Powell later on today, but it seems like a pause is what will be the announcement. And then more importantly is what happens next. Is the Fed going to pause for a month and maybe raise rates in July, or could the Fed be done altogether with this rate increase cycle? A lot of questions to ask, a lot of answers to get. We'll try and get some of those from Nina Trentman of Bloomberg. She is the team leader for corporate finance. Nina, great to have you with us back on the show. Thanks for your time.
Thanks for having me. Good morning.
Good morning. All right, so the CPI yesterday and even the PPI report today, that would seemingly make it feel like we're almost in a lock, if we weren't there already, that we're not going to see a rate increase today, that it is the time to pause at the moment.
Yeah, I think that's what we've been seeing if we're looking at market pricing this morning. The readings yesterday and today were certainly on the inflation front enough of a signal for markets to expect that we won't see another increase announced by the Federal Reserve today. Of course, that leads to this question as to, is the Fed done hiking rates, or is there actually going to be one more increase later this year? We've seen Bloomberg Intelligence this morning pointing out that potentially today will just be a hawkish skip rather than the end of the rate hiking cycle, with markets pricing in either another hike in July or in September, because of course, even if those inflation figures are softer and haven't been increasing more, we are still seeing, of course, that the are far away from the 2% inflation target that the Fed has given itself. And so there is this question as to, are there more hikes to come, or will the Fed also want to give more time for the existing increases that we've seen in the past 15 months to feed through the economy?
Well, in terms of the messaging that we have heard from Chairman Powell over the last several months, it has always seemed, for the most part, maybe I shouldn't say always, but for the most part, it has seemed like he has not wanted to box himself into anything. And certainly you would think that if there is a pause, he would not want to box himself into saying, yep, we're done, it's over, we're not going to worry about it again, because as you alluded to, there is still some stickiness in parts of the inflation story right now.
Yeah, I think that is important from a just monetary policy perspective to signal to the market. Yes, we are aware that inflation has eased, or the pressure on inflation has eased, but we aren't there yet, and therefore we still have instruments in our toolbox that we can apply. At the same time, of course, the Fed is also aware that, like, there was the SVB failure and other regional bank failures earlier this year. So there's also this awareness within the Fed that you also don't want to increase rates too much in order to not break things. I think there is this awareness that increases have been sharp and have been coming at a steady pace. So there is, of course, this momentum to say, okay, let's wait one meeting to see how things are going. And of course, then also you see the Federal Reserve as one bank amongst others. So we've seen the Bank of Canada and other banks sort of moving to increase rates again. That is something that the Fed could still do potentially at a later point in time this year.
Now, that being said, even if the Fed were to not raise rates now, not in July, and maybe even not at the remainder of this year, there is still, as you said, that component available to them that they could do that. And then the other side of the story is how they basically play the rate game moving forward in terms of raising or potentially even lowering rates at some point. I don't think that's an expectation for this year at least, but certainly at some point it's going to be brought up to the FOMC and to the leaders of the Fed about pulling back on rates for a while.
Yeah, I think it's an interesting point that you're raising. We did see earlier this year market expectations that there would be a rate cut sometime later this year, given that the expectation was that sort of the move towards economic slowdown and potential recession would be clearer. Of course, we're still waiting to see what Q2 data will bring at the end of the month once the quarter is over. But I think at some point, yes, there will be this question for the Fed. Will you cut rates? But also then at the same time, we're coming out of a period of very accommodative and very low interest rates for a very long time. And we've seen this sharp increases in inflation since the pandemic. So there's also this sentiment that potentially there will be just elevated rates for a longer period of time. And I think that's what we're hearing from companies and from CFOs and treasurers that we speak to, that the expectation is not that there will be a sharp decline in interest rates again. Yes, there could be a gradual decline over time, but the expectation amongst executives is very much that this elevated interest rate environment that we're currently operating in is something that we'll see for a bit longer. And that's also what you're seeing companies preparing for. Depending, of course, on the healthiness of their balance sheets, that is a problem, or it isn't also a problem. Like amongst the blue chip companies, we've seen interest rates and financing costs go up, but we are also seeing that companies largely are able to manage that. Whereas then on the high yield side of things and also the more distressed businesses, higher interest rates for longer is causing severe problems because these companies don't necessarily generate enough cash to meet the higher interest expenses that they have.
When we talk about stickiness of inflation, the conversation is really focused on food, to a degree on energy, but also on shelter costs. Where are we in terms of looking at those areas? And are there other spots in the economy right now that you see or you hear from experts that are seeing some stickiness as well?
Yeah, I think, as you said, shelter is one important point. And then also what we're hearing is just sort of costs for services, business services, and also other sort of service areas where so far the picture has been more mixed. Of course, there are also big regional differences that we need to keep in mind. But that's something that we're also hearing from businesses, that wages are still, and wage expectations, even though they have come down, they aren't sort of falling as sharply as you would think. And sort of we're also seeing other service costs remaining elevated. And if you look at certain patterns, like consumer spending patterns, people are still spending big time on experiences, travel, restaurants. Yeah. So those are all things that are keeping that service cost inflation at an elevated level.
Your colleague Steve Matthews has a good kind of breakdown of some of this on Bloomberg's website right now, and I'm looking actually at a chart that you guys have on there. There's still an expectation that the unemployment rate is probably going to be a little bit higher, above that 4% range as we're going into 2024 and 2025. And it's not until, beyond that point that we maybe see it pull back below 4%. So that component of the labor market in general really is still an important focus.
Yeah, as you said, that's totally agree. Like in the end, of course, the Fed focuses on price stability and its inflation goal, but it also focuses on unemployment rate, health of the labor market. And of course, that part of the equation has been for the past few quarters been remarkably strong and stronger than many had expected. And until you see some changes there will, of course, be sort of slowness for the Fed to step away on the rate side of things. So I think that's another important metric to watch, as you said. And I think what I hear from executives still is that there's a shortage of certain qualifications, certain people. It's hard to find the right talent. Of course, we've also seen some big companies like laying off more workers, but still I think the numbers are showing that inflation remains at a near like a historic, like near to close to a low, and so that's an important consideration for the Fed as well.
Is the feeling that the Fed will be able to get down to that 2% target at some point?
Yeah, I think it depends on how you define at some point, because yes, I think the Fed has signaled very clearly that 2% is its target, and we've also seen suggestions in recent quarters saying, well, maybe 2% is just not the right target for us to work towards. But what I'm hearing from central bankers is very much that there's not going to be a move away from the 2% goal for now. And so I think it's just a question of time until we will get there. But how long that might take is anybody's guess.
All right. Great to talk with you, Nina. Thanks very much. All the best.
Thanks for having me. Appreciate it.
You got it. Nina Trentman of Bloomberg.